a guide for now. So what happens in a final return other than your departure date? Well, let's talk about some of the assets that you might have in Canada. So if you've got RSPs as an example, you can maintain them as a non-resident. You do need to let your financial institution know that you're a non-resident, so they register it as such. So that's important. Any of you that have Canadian pensions, so if you were with a former employer in Canada that had a company-sponsored pension plan, you can maintain it in Canada. What they probably did is they probably rolled it into what's called a locked-in retirement arrangement, or a LIRA, and then they allowed you to self-manage it through a pension fund administrator, like say Sun Life as an example. So you can maintain that as a non-resident. You just have to inform the pension board or the financial institution that runs the pension that you're a non-resident. Now, what if you have investments outside of registered plans? How does that work? Well, let me give you an example. So let's say you own stocks or mutual funds in non-registered plans, and let's say you bought Bell Canada shares for $3 at some point in the past. And on the day you departed, they were worth $5. So I'm only talking about non-registered plans, meaning you just own an account with TD Waterhouse. Well, on the day that you left, what Canada wants to do is they want to take any accrued value in your investments and tax it, as if you sold it on that day. So in my example, let's say you depart and on the day you're in the airport leaving for Hong Kong, the value of your investments are $5 and you bought them for $3, then Canada's going to tax you on the $2 differential. If the investment then goes up to $10, Canada doesn't care. We're not going to tax you. And if it goes down, we're not going to allow you to accrue any of the loss. So basically what's happening is Canada's saying, we're going to tax you while a resident, but whatever happens after is up to you. And irrespective of whether you're taxed in Hong Kong or not, so Hong Kong doesn't tax capital gains or investments offshore that are in capital nature investments, it doesn't matter. Canada doesn't care. They're not trying to determine whether you should be taxable in Canada if you're not taxable in the other country. That's not a determining factor. So when we look at the concept of departure tax, it's really just to calculate any of those departure assets. Always remember things like capital gains are sourced to the country of residence, so you'd be taxable possibly in the country that you live in, but not Canada if you don't live there anymore. Now, for the RSPs and pensions, if you ever dispose of them as a non-resident, you'll be subject to non-resident withholding tax, which is a flat 25% withholding tax. But then Hong Kong doesn't tax you on any of that income that you bring in, so you just be subject to that 25%. Now, from an RSP perspective, it can be advantageous for non-residents to dispose of RSPs, let's say in retirement if you continue to live here, because your average effective rate in Canada, if you're a high income earner, can be as high as 40 to 45% on disposition of an RSP. But because no matter what your income here in Hong Kong is, we're only taxing on a flat non-resident withholding. If you live abroad, you'd only be subject to 25%. So there could be some good planning when it comes to RSPs. If you have a non-working spouse, and this came up today, and let's say you dispose, she or he were to dispose of the RSP, and if 90% or more of your worldwide income is from a Canadian source, then you can actually dispose of about $10,000 a year in your RSP and there wouldn't be any income tax. So that's some good planning in terms of getting funds out of an RSP into retirement if you're not living in Canada. And I'll answer more questions about it later if it comes up. Now, principal residence, this is where I want you guys to start writing some stuff down because I'm going to save you big money right now, okay? So I'm going to save you money on penalties. Now, the very first thing is if you owned property in Canada at the time of your departure, you were required to fill out a form on your departure return called a T1161 form. So you can go to Google and type in T1161 and fall asleep tonight reading it because it's really interesting. It's not very interesting at all. All it is a disclosure of property that you own in Canada greater than $25,000. And you're required to file that form by April 30th of the year following your year of departure, or there's a $2,500 penalty per taxpayer. Now, if you hadn't done it for the year that you had departed, so for those of you that left in 2009, you still have time. If you left in 2008, it would have been due by April 30th, 2009. You still have the ability to file based on a program in Canada called the Voluntary Disclosure Program that the Canada Revenue Agency runs. So if you forgot to do something that you were supposed to do and you didn't do it, you can still voluntarily do it and potentially they would waive any penalties on non-compliance. So that's one of the areas that you've got to be aware of in terms of some of these filing requirements for departure years. Now, if you owned a home in the year of departure, be aware that if you continue to own it, you can't continue to claim the principal resident exemption on the property for the years you don't live in the property as a resident of Canada for tax purposes. So up until the time you departed, if you had lived in it, you could claim the principal resident exemption, but you can't for the years after. So there are a couple different filing options that I'll get into later if it comes up as a question, but there is some planning around utilizing the principal resident exemption to get maximum use out of it. Okay. Now, if you own a rental property in Canada, the most common error is people say to me, okay, I own a rental property and I've got revenue of $12,000 or $10,000 and I've got expenses of $12,000, so I'm in a loss position. So I don't have to do anything. Well, you actually have an ongoing filing requirement in relation to withholding tax. So what the Canada Revenue Agency says is that if you rent a property out, you're required to withhold 25% of the gross rent of the property on a monthly basis and remit it to the Canada Revenue Agency temporarily as withholding tax. Then let's say you file your return at the end of the year, and in my example, you're in a loss position. You can then claim all the withholding tax back. If you're in an income position, then you would pay some of the withholding tax against the income tax that you owe, and then they would give you the difference. So it's very similar to when you were working in Canada and you earned income through your employer, and they would withhold the tax, and then you'd file a return at the end of the year and you'd either pay more or you get some money back. Similar concept with withholding tax relating to rental property. The reason why the government wants you to file and withhold is in case you run away and never file a return, they've already got your money. Now, there's another option where you can file something called an NR6, which is a pro forma request, and you're basically projecting what you think your rental income and expenses are going to be. And if you're in a loss position or only a slight income position, then you would just remit that as withholding tax, and you wouldn't have to remit the full 25% withholding. But there are other requirements around it that I'll get into later if the question comes up, because I don't want to bore you with it right now. But generally speaking, those are your options. You still have to file a return each year, irrespective of whether you earn rental income on a net basis or not. Okay, I'm going to save you money again. So any of you that own property in Canada, you have to be aware that if you ever sell the property as a non-resident, you do have to file a tax return, a non-resident Canadian return for the sale of a property. As well, your lawyer or us as tax accountants would file a form called a T2062 form within 10 days of the date of closing of your property. If it's not filed within 10 days, there's a $2,500 penalty. So what the Canada Revenue Agency loves to do, especially for expats, is they charge them these big $2,500 amounts all over the place for doing things wrong, because that's their way of collecting for people that are non-compliant. Up until about 2005, the rules were in place, but they weren't adhering to the non-compliance penalties, and now they charge them no matter what. So just be aware that you do have filing requirements as a non-resident. If you sell your property, you've got to file that form. You've got to file a tax return for the year of sale, irrespective of whether there's tax on the gain. For most of you that